Hello, and welcome to the Advanced Projections April 2021 Macroeconomic Report and Review. Since our last report, we have seen the major U.S. political dramas decline further. The new administration has continued to move forward very aggressively with its initial agenda, most prominently consisting of a solid and proactive program of slowing down and then eventually eliminating the consequences of COVID through vaccination, as well as the passage of the rescue package of financial assistance and fiscal stimulus. Vaccine doses are currently in very broad and deep distribution nationwide, with 1/3 of the population, about 110 million people, having already received at least one dose of vaccine. Full inoculations have now reached nearly 20% of the U.S. population. As of today, April 10th, the new and substantive stimulus to individuals has been largely distributed, initially providing useful economic benefit to the nation as a whole. The recent extension of unemployment benefits through the entire summer, as well as substantive payments to the bottom income half of the population, are designed to add impetus to the economic recovery. As we have said in our last 5 months' reports, Recession 2020 technically ended in fourth quarter of 2020. There have been continuing improvements in expectations for better days ahead, accompanied by continuing rampant speculative excesses in the equities markets as well as elsewhere, such as in cryptocurrencies and some precious metals. Real estate prices have advanced sharply in upper-end housing, and that trend is likely to continue throughout the summer as low mortgage rates and short housing stock supplies continue. Margin borrowing again hit a new record in February, and it is sure to have climbed even more since then. The party in equities continues almost unabated. Last month we said there was nothing visible on the horizon that would pierce the bubbles in the equities markets, but that caution was still warranted in taking positions in markets which are outrageously risky from valuation standpoints. During March, a first crack in the mirror may have appeared, right in keeping with our recent warnings about excessive margin debts and equities prices. In a period of about 48 hours, a previously invisible $30 billion hedge fund, Archegos Capital, nearly all funded by margin debt, completely collapsed, leaving major funding banks, including Credit Suisse, holding the bag for billions of lost dollars. More details about this are found in our APSI indicator section. Now for the underlying socioeconomic situation. We said last month that our expectations for COVID cases and fatality tolls would continue increasing for many months into 2021. As of now, April 10th, 2021, U.S. cases reached 31 million, an increase of about 1.8 million in the past month, compared to an increase of 2 million in the previous month. New cases have held steady at just under 70,000 per day. U.S. fatalities have reached past 574,000, up approximately 33,000 in the past month. If we use the reliable ratio of total fatalities divided by the total resolved cases, the fatality rate is much improved to about 2.1%, a 25% decline in that grim statistic since the beginning of the year. We are now past our third wave in the USA, as new case and fatality numbers have dropped substantially from January's peaks. But we are still at the top of both the global lists for total cases and total fatalities. In spite of only having 5% of the global population, we still have more than 23% of the global cases and 19% of the global fatalities. More highly transmissive and virulent strains were identified as incoming from Great Britain, Brazil, and South Africa when cases of those forms appeared in the U.S. as early as November of last year, and now continue to appear in increasing numbers across much of the country. New U.S. cases have increased slightly over the past 2 weeks, as we projected last month, and the variants that have been discussed here and elsewhere over the past couple of months now have come to dominate an incipient fourth wave of cases. So far, The existing vaccines appear to protect against the known variants, but the variants are appearing to be more harmful and more plentiful amongst the younger folks under age 45 than the initial version of the virus. The number of people who are dubiously titled long haulers, those with persistent post-critical infection symptoms and issues, continues to increase and will add to the burdens already placed on the nation's healthcare system. Globally, cases have reached 135 plus million, up by about 17 million in the past month. At this moment, there are more than 500,000 new cases being reported daily on average. Global fatalities have now solidly reached past 2.9 million and will likely reach 3.1 million by the end of April. Brazil and India are now showing very great stresses from the pandemic. A fatality model we have been using since it was created on November 20th of last year and have then been modifying periodically shows the danger in letting the pandemic resume its havoc here in the US. At the beginning of March, we were still running above this original projection in terms of actual fatalities versus the model. So we would have had to wait and see for another couple of months if the problem is truly being solved, as would be evidenced by actual fatalities declining below the model's curve. We updated this chart on April 2nd and provide it below in our report. At that time, fatalities were just at the projected levels made 130 days before. We are now more optimistic about this initial improvement, hopefully expecting new fatalities to fall below the curve in the coming months. We will be waiting for the data to show that we're solidly moving down and currently expect to see that more clearly in the next 60 days. We also hope for continuing rapid deployment of the vaccine and expanding public acceptance of the necessity of being vaccinated. We have also noticed the emergence of a, quote, return to stricter vigilance, unquote, and some attempts to identify future species-leaping viruses amongst government-run health organizations, which should help in detection and containment of future potential pandemics. Now for the current economic environment. In March, unemployment levels moved down moderately again to a national level of 6.0% after a monthly gain of 910,000 non-farm payroll jobs. As we had been anticipating for several months, return-to-work gains had flattened well below a full recovery level. February and March results show a slightly improved picture. That is clearly illustrated in two charts that we provide courtesy of the U.S. Bureau of Labor Statistics dated April 5th. Adding in the gains during March, we still have approximately 8.5 million jobs lost since January of 2020. Our view is that job gains will continue to return slowly, taking 15 to 20 months more to erase all of the remaining job losses created by the pandemic. Many of those old jobs are now permanently gone, and newly created ones will be required to fill in the gap, presenting a challenge to the current administration and Congress to move forward beyond rescue and into recovery planning. The currently discussed infrastructure plan for America could certainly help with long-term employment improvements. One can use a nominal figure of 4% unemployment as a target for the Federal Reserve to consider a gradual end to their highly accommodative interest rate and money supply policies, beginning perhaps in mid to late 2022. First quarter of 21 corporate earnings reports will be coming out over the next month, with little anticipated evidence of systemic weaknesses. It is likely that first quarter year-over-year total earnings for the S&P 500 could be up about 21%, which is strong given the circumstances, but it is hardly anywhere near the amount that would justify the leap in equities prices over that same one-year period. To put this in perspective, it would put earnings for the first quarter at about even with the first quarter of 2019. Second quarter 2021 earnings are currently projected to be just a bit more than second quarter 2019. More robust growth is expected in the second half of 2021. Equities market pricing has continued to power ahead with more volatility and pushing ever deeper into bubble territory. There are now increasing warnings being put out in the financial press, as well as by indicators utilized by investment bankers that warn of a corrective environment may be forming for equities. Recent data suggests that equities have tended to correct 10 to 12 months after the resumption of GDP growth after a recession ends. That suggests a potential window for a correction of September to November of 2021. We still concur, but can only speculate when the new market highs will stop forming. Some trigger is usually required, such as a downward surprise in corporate earnings and/or many banks reducing their exposure to market excesses through the deleveraging of margin borrowers. We continue watching market performance and growing margin borrowing levels, which is our favorite tool for tracking speculative excess. The last peaks in margin borrowing showed up before the two large corrections of 2018, both of which we predicted. During Recession 2020, margin debt increased by nearly 50%, where people were clearly hoping for positive prospects and results from massive federal intervention for the economy going forward. From a $665 billion level in October of 2020, margin debt was then a mere $35 billion away from its all-time high of $700 billion, set at the end of 2017. And that's about where it was when we first warned of the market corrections of 2018. During November of last year, margin borrowing penetrated those record levels and is now at historic highs, with the last reported level at approximately $810 billion, as it increased $50 billion in September, $40 billion plus in January, and another $20 billion in February. Circumstances are vastly different from 2018's interest rate environment, but heavy margin borrowing that is synchronizing with markets making significant new highs is a likely driver for a market correction beginning soon. Last time we said this, the correction began within 3 months, and it came in two waves during 2018. The latest information on margin debt is from February of this year, shown in a fresh chart below from Advisor Perspectives. We expected to see further large increases in this during February, which did materialize, and it is likely that March will also show an increase. Under similar circumstances seen in this chart below, two blue index drops of 50% of real value followed shortly after each major correction began. A similar size drop now would take the S&P 500 index to well below 2,000. Why do levels of margin debt matter? Overheated markets are characterized by higher levels of speculation. Speculation means placement or creation of riskier investments beyond what would be prudent in the case of perfect knowledge of the existing circumstances. The more speculation, the greater the risks, and vice versa. Using leverage, i.e., borrowing the funds to capitalize the speculation, exposes the investor to even greater risk. If the position, consider it a bet at this point, goes wrong, huge losses can be incurred. The investor may be wiped out completely, and those who have loaned the funds for the bet will also lose. In March, a highly leveraged hedge fund operating under the radar of market scrutiny used both sophisticated means, derivatives called swaps, and lots of borrowed money, reaching a total position worth $30 billion. It declined somewhat to $20 billion, and then within 48 hours evaporated completely. Several major banks were exposed to the risk through loans made to the hedge fund Archegos Capital, including major Swiss bank Credit Suisse. In February, Credit Suisse lost approximately $1.5 billion when another risky client, Greensill Capital, unraveled. The Archegos fiasco has cost Credit Suisse another $4.7 billion. More on the details of the Archegos collapse can be found at a link we provide for an article from Bloomberg.com. Massive damage to and outright failures of investment banks occurred at the beginning of the Great Recession due to their exposure to huge speculations in the global real estate bubble. While not yet at the same scale, at least per our current visibility, there could be a lot more exposure which has yet to cause damage. Smarter banks could begin to tighten up on speculative lending, which would then dry up some of the buying pressure in the equities markets. An incipient equities correction would also tend to initiate margin calls, whereby margin borrowers are required to pay back some or all of the principal they have borrowed, furthering market selling pressures. If there is enough of this hidden leveraging that is driven to deleverage, then we're off to the races into a major correction situation. Much of this situation is hidden from all but the most financially astute and tuned-in individuals who would undoubtedly seek to further their own fortunes by taking positions counter to those who hold the highest risks. To see how this happened in the 2000 to 2009 era, we refer you to the very entertaining and informative movie The Big Short to illustrate just how this happened ahead of the Great Recession. AP does not have a quantitative feel for how much leverage is entangled within the current equities bubbles, but it is likely that there is a lot. Archegos hid their speculations within derivatives called swaps, and the collapse in value of swaps was at the heart of the Great Recession triggers as well. Just as fast as everything else has happened in the past 15 months, a large correction could develop at an accelerated pace, so caution and prudence are still our advisory watchwords for your own equities exposures at this time. Now for the AP individual indicator information. March's closing value for the S&P 500 keeps our AP SI indication as red, with that index moving even further into blatantly overheated territory after a small correction in the first week of March. Another primary indication of the top-heavy nature in equities is the widening spread between the S&P 500 and a metric representing 10% of the GDP. This gap continues to grow as shown here in our third chart. We see this as an indication that more and more of our money supply is being directed towards speculative activities rather than into solidly productive activities, i.e. goods and services. This is our form of what is more widely considered to be the Buffett indicator, and the upper smooth curve is the boundary between a warm market and a bubble zone. There's an additional chart here, which we first showed in our March report, also courtesy of Advisor Perspectives. It literally shouts out how risky the U.S. equities markets are using a set of 4 indicators, very similar to our own in philosophy. The risks now are at all-time highs. Status of our other AP indicators. The AP-MS money supply indicator remains solidly green as the Fed continues with their expansion of the money supply, now reaching $19.6 trillion, up 24% since the beginning of 2020. The newly passed $1.9 trillion rescue stimulus will add further to the money supply over the next 60 days, as we shall see in next month's and second quarter 2021 numbers. Recent action in gold prices show testing of and rebounding from support levels just below $1,700 per ounce. Silver behaved similarly during March, moving down in the $26 to $24 range and rebounding quickly from $24. Rhodium moved wildly, first to a new all-time high level as speculators continued to move in strongly, pushing prices to $26,000 per ounce, then rapidly down to $20,000, and then right back to a new high at over $27,000 per ounce. Platinum has now doubled its low set in mid-2019 and could be the next target for speculation since it is still a third below historic highs set a decade ago. Month-end prices for gold and rhodium keeps our AP-PM indicator deeply into the red. The February LEIs from the Conference Board again improved slightly, and for this report, our AP-LI indicator stays at yellow now for 5 months in a row. We still expect slowly improving LEIs to continue during the next few months. The Conference Board also improved their outlook for an improving recovery, and that we should expect a more robustly recovering economy well into 2021. If these slight LEI increases each month continue, we'll be back in green territory here, perhaps in just another 30 days. All of this is predicated upon the absence of an equity market correction during these intervals. Our APYC indicator continued green for 2 months, the first time since May of 2018. The yield curve is now moving all on its own towards a more normal shape, with the short end firmly anchored near 0%, but the long end up well past 2% for the 20 and 30-year treasuries. Higher yields also moved into shorter terms, with the 5 and 10-year yields both up about 0.2%. This is indicative of more improving confidence in the economy, with a modestly declining demand for longer-term safety. But in the respective shorter term, less than 2 years, it is not a sustainable paradigm. Should any other potholes occur in the road to recovery, the Fed now has little room to do anything on its own with short-term interest rates to further stimulate. If inflation pops up, as well as a further expansion of the equity bubble, the Fed may be forced to react, raising short-term rates, which would likely collapse the bubble, assuming it does not already do so under its own weight and imbalance. The third quarter 2020 GDP grew substantially upward from its enormous decline in the first half of 2020. The traditional measure and definitions of recession have already indicated a technical end of recession 2020. However, neither the NBER nor the Federal Reserve have yet to take official notice of this technical end. However, advanced projections declared earlier that recession 2020 had ended approximately 8 months after it began. The Federal Reserve's weekly aggregate measure of economic stability remains in a position of relative safety, but the Fed itself continues to stay with the NBER declaration of recession within all of their data sets. Therefore, our AP-FD indicator for this report remains red, now for 11 months straight. Note that this may change retroactively if the NBER and the Fed start to acknowledge the fourth quarter 2020 recession end. We continue to maintain a cautious stance here. The economy is still weaker than it was in January 2020 before COVID hit our shores. Now, just past a large third wave, COVID variants have the potential to spread rapidly during this spring. Control of this situation will determine if there is a second GDP dip and perhaps a recession 2021, which we have lowered our probability on. Real-time events will determine this, as the majority of our standard set of indicators have not yet even returned to green states. We expect them to do so very slowly over many, many months. We will have to basically rely on a direct, short-term watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several months, which are inherently less reliable short-term indicators of recession potential. So in summary, only 2 of our 6 indicators are in green territory, and we reflect that in our slightly lowered probability of another near-term recession to 60%. It actually would be lower if the equities markets were more tame in their behavior. We calculated that the actual onset of a recession had already begun just over a year ago, a fact which was then confirmed by the NBER in June of 2020, and it became officially acknowledged by the Federal Reserve later in the summer with the adoption of NBER's declaration within the Federal Reserve datasets. However, as we have frequently noted, the technical end of Recession 2020 already occurred late in the third quarter of 2020. We continue to maintain that this is a very risky equity market environment with the potential for significant and protracted drops or flash crash scenarios based upon the disparities shown in our charts this month. Only those with the highest tolerances for risk should be speculating in the equities markets at these levels. High speculative valuations never persist, and a return to the mean or worse becomes more likely with any new unexpected disruptive influence. The only moderating influence in this scenario is that the Federal Reserve has continued to state a longer-term near zero interest rate environment, and that tends to fan the fires of market speculation. This situation could persist for a couple of years, or some new black swan event could arrive to pop this bubble in short order. What we also continue to ponder here at AP is the economic setup for this decade. Is it possible for history to repeat itself in that we could expect to experience another roaring 20s as public confidence, optimism, and spending take over once COVID is truly behind us? Despite the glossy economic reputation of the 1920s, there were 3 recessions in it, even before the big one. Will a more responsive and proactive Fed and a hands-on administration improve our prospects for sustained economic gains? Well, that's all we have for our April report this month. Thanks for listening. We know that these reports keep getting a little longer each month, but as we dig further into economic data, we have more basis for the claims and projections that we make. So we'll talk to you again at the beginning of May. Thanks for listening.